Good morning, everyone. Thanks for tuning in today. My name is Matt Wilson, and I'm the Finance Officer here at DuPage Foundation. On behalf of our board, investment committee, and staff, I'd like to welcome you all to today's webinar with our partners here at Northern Trust. Before we start, just a few housekeeping notes. Today's webinar is being recorded and will be made available to all participants. If you have any questions, please use the Q&A feature at the bottom of your Zoom window. We will address them during a segment near the end of the hour. We did have a change in presenters for today. So with that, I would like to introduce Ryan Boyle. Ryan is a Senior Vice President and Senior Economist with Northern Trust. And we have Marty Morris. Marty's a Senior Vice President and Portfolio Manager with the Foundation and Institutional Advisors Group. So with that, I'm going to pass it over to Ryan. Let me just share my screen here real quick.
Marty, you had some leadoff points, right?
Yeah. Maybe just to kind of broadly introduce Ryan. So I'm Marty Morris. I'm the Foundation Institutional Advisory Practice at Northern. For those not familiar with our team at Northern, we work exclusively with foundations, endowments, other nonprofits as an outsourced chief investment officer, or OCIO. We're a proud partner of DuPage Foundation, really kind of working with them on investment policy design, strategic investment planning, and portfolio construction, and kind of bring to them kind of the world-class investment resources in Northern Trust. One of those resources I'm happy to have with us today is our special guest, Ryan Boyle. Ryan's been instrumental in helping us kind of navigate this evolving macro environment. Ryan and his team have been ahead of the curve on forecasting resilient growth and a patient Federal Reserve, both of which have played out recently. And so with that, Ryan, I'll pass it over to you to see what's on top of mind for you today.
All right, thanks so much, Marty. I'll try to hold to a half hour or so of me talking. I really enjoy the Q&A portion, so I hope you have some questions for us. Please send them in to Matt over Zoom. Title of today's discussion is Sticking the Soft Landing. How far we have come, that I dare put that in bold font, sticking the soft landing. I last spoke to you all, if my calendar is correct, it was early May of last year. And, through the first half of 2023, soft landing felt like a punchline. No way we can get through bringing inflation down without a big increase in unemployment and careening the economy into recession. It had never happened before. And I made a tentative, plaintive case for what could go right, why we're not ready to make a recession call, why we think inflation can improve with only modest increases to unemployment. Thus far, it's playing out. I say that with some pride, and I also acknowledge we've gotten lucky. After a lot of things went wrong for a while, we've had a little bit of good fortune here and there, and overall, we have learned just how resilient the economy can be. Hopefully, this soft landing notion works out. The longer that it remains possible, the more likely it is to actually happen. I'll be ready to declare victory when we actually see the Fed cut because inflation is coming down, not because there's a panic. Think about why the Fed usually cuts rates. It's because something breaks. Can we get to the point where inflation is coming down, unemployment stays low, and the Fed feels it's okay to reduce rates just because the economy is functioning well and we can get out of restrictive territory? That's the soft landing. Never happened before. Usually the Fed has to cut in reaction to something. We are on track for that to happen. So I can't say we've achieved the soft landing, but it is in sight this year, fingers crossed. Starting out here with some broad themes that we laid out as we approached the new year. You can see our annual outlook for 2024 on northerntrust.com. And please feel free to subscribe to any of our publications. They are open to the public. You don't have to be a client, but thank you to all of our clients on the call. What I'll focus the most on here is this theme of releasing the brakes. Central banks around the world became very restrictive in a hurry. Coming out of the pandemic, inflation took off. Central banks have a mandate to keep inflation under control. They had to react quickly. We could argue maybe they did too little too late, but they tried and they came out forcefully. This will be the year that they can actually get out of restriction and get back toward neutral. Figuring out what neutral is and moving there will be a challenge, but that's going to be in sight for this year. No more restriction, but figuring out the right pace of accommodation. We also have to worry about the debt that we've accumulated, certainly on government balance sheets coming out of the pandemic, but also all around the economy. There is a lot of debt and it's getting more expensive. How will we sustain that and what burden will it face? As we look to the global economy, I'll spend less time here, but of course I'm open to questions here. We have a whole new China in the world. It's not the same country that it was from, say, when it joined the WTO around early 2000s, that rapid streak of growth. They became a whole different country. They can't keep growing in the way they did, and they have a lot of domestic challenges to work their way through. That's going to cause a lot of reverberations all around the world. And then, of course, polarization. We've got work to do, and it's getting harder and harder to agree on even what the problems are, let alone how to solve them. So those are the broad themes. And as I say, we'll focus on releasing the brakes. What's happening in terms of the Fed and what's influencing their decisions? Thank you, Matt, for running the slides. We can go to the next one. I think the January FOMC meeting really told the story. I don't usually show this much geeky detail. And anytime I've sent the slide around, I get a question, hey, is this a giant typo? No, what I've tried to show here. It's not coming through clearly for me. I hope you can all see. It's kind of stuck in a transition. What I tried to show here is what changed in the FOMC statement, like a Microsoft Word changes tracked. What was deleted, what was added, and what's crucially, what was added, the committee does not expect it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving sustainably toward 2%. This was the committee trying to say in their roundabout language, we're not cutting yet. Don't look to a March cut. They saw what interest rate futures were pricing in. We know the Fed's going to cut this year, not January, why not March? And it's a good question. Why not March if we are moving toward 2% and that's the goal and employment isn't worrying yet, as I'll discuss? Why not start cutting in March? Powell got asked about this repeatedly, and about a half hour into the press conference, he finally got pretty explicit. Do not take March as the most likely case or the base case. Jay Powell's an attorney. He knows how to leave every option open in his responses, but that made it pretty clear. The Fed is in no great hurry to cut. So why would they rush? I mean, let's take a look at the next slide, the case for staying patient. Why would the Fed cut? It's usually to stimulate the economy, and this is an economy that is not in need of stimulus. Fourth quarter GDP grew at an annualized pace of 3.3%. That's outstanding. Normal, if everything is just steady state, you'd see roughly 2% annualized growth. There's always some noise about it, but to see a reading over 3 was really high, especially when we had nearly a 5 in the prior quarter. And as we look to the full year, fourth quarter over fourth quarter, we grew 3.1%. That's in a year that the widespread expectation was a recession, that we didn't really have confidence that we could pull off this soft landing. It turned out to be a great year of growth. And what's really led that continual growth has been consumer spending. We've had some ups and downs, most recently some ups due to some unpredictable factors around the trade balance and what's happening in inventory accumulation. Those have come up really strong for the past couple quarters. That won't sustain. Consumer spending, though, really has. Even adjusting for inflation, we continue to spend more. This is a great thing for the economy. It's a sign that even though these consumer sentiment surveys have really been in the dumps for quite a while, perfect negative correlation with inflation. The more that prices are moving up, the worse consumers feel. Inflation is improving. That probably helps. But if consumers really felt bad, if we were really nervous about the economy, we would slow our spending. Even if I don't lose my job, if I see my coworkers, maybe getting laid off, I think I might be next. I start saving more. I cancel my vacations. We're not ordering out to eat, that sort of thing. And we're just not seeing that change in behavior. This all comes down to a really strong labor market. Quite a remarkable jobs print in January. Just as we've been expecting a slowdown, we got 353,000 jobs created, holding at 3.7% unemployment. It wasn't a perfect report, and there was probably a lot of seasonal noise about this. January is always a slow month, so it has a big seasonal upward adjustment. It was bad weather, so that probably messed with the hours worked. There was a lot to find in the details of that report. Overall, we're doing fine. We don't want to dig into the details to find reasons that we have to make a bear case. It's more, let's take the good news with a grain of salt as well as the bad. That was a very good headline. Strong job creation, nice low unemployment rate. We hear some anecdotes of layoffs. They're in the news. They're not really showing up much in the data in terms of initial unemployment claims or seeing the unemployment rate rise. Looks to me like the job market is still tight enough that people are able to find jobs pretty quickly. And I've shown this on the next slide. This series jolts. I probably showed this a similar chart last year. How many job openings are there? It is holding at a historically elevated level, and maybe this is just the new norm, but there are more job openings out there than we had ever seen pre-pandemic. Even as that has run down to around 9 million or so, it's still a very high number. And it was remarkable back in 2018, what looked like a tight labor market. I'm on my slide 5. I think we're one behind. Can you go one more slide forward? Starting with labor market no longer overheated. Yes, this. Perfect. Thank you. It was remarkable in 2018 when, now we've gone one too far. Remarkable in 2018 when jobs became 1-to-1. How many open jobs are there relative to unemployed people? 1-to-1. If you wanted a job, you could find one. That launched up to 2-to-1. If you were ready to get back in the labor force, you could find 2 jobs without much hesitation. And that's still coming down, but still it remains pretty high. That is the tight labor market. Hiring is settling down. It's not slow, just settled down to the historical norm. Quits also settling down. When quits take off, why do people quit a job? It's typically because they found a better one. Better pay, easier commute, better match for your skills. Could be because they're ready for a break and they're confident they can come back, or it's that they're choosing to retire. And all of those are signs of confidence. We're seeing that normalize, but not fall off. You don't want to get too hot. It's back to normal. And as I say, unemployment claims holding at a nice low level, consistent with an economy where even when people are let go, they tend to find their way back into the labor force pretty quickly. And that is important. Here's the view of consumers up on screen now. It tells a mostly good story, and this is what I mean that consumer spending has taken off quite well. What's notable, as I say, consumer sentiment really fell off. That was when inflation went really high, even though wage gains were quite good through this cycle. Hope you all got raises at some point or had an opportunity to move into a better paying job. There's been a lot of turnover, a lot of rewards for loyalty, a lot of rewards for moving. We can go one slide forward. Can consumers carry on? It's great to get a 5% raise, but then if the rent goes up by 10%, it really doesn't matter. And it's just washed away, and it feels like we can't get ahead. And that shouldn't be the norm. But over the past half year, wage gains have exceeded inflation. We're back to getting ahead on a real basis. That's helping consumer sentiment turn around. Things are getting better. Even though it might take a little while to feel it, that's starting to echo through. What also drove sentiment down is just this sense that the disconnect between how economists talk and how regular people talk. When we say inflation is coming down, that means prices are not shooting up quite as quickly. But when an ordinary layperson hears inflation's coming down, they hear that as prices are coming down. No, and they won't. That's just not how inflationary cycles work. Outside of maybe a few overheated segments, a few bubbles here and there, like for instance, used cars really took off because new cars weren't available. Prices on used cars got bid up. They're normalizing. You're seeing prices fall there, getting a bit more normal, though still high. When it comes to the grocery bill, eating out at restaurants and so on, those prices are the new norm. That's how every inflationary cycle has been. Prices go up and level off, wages catch up, and that's the new norm. And prices just feel different now. It takes a few years for that to feel normal. It's a challenge for messaging. It's a challenge for us economists to try to, get our words understood. The prices have stopped running up, but no, you're not going to see prices come back down. The good news is, though, your salary is not going to go back down to 2018 levels either. There are hints, though, and I want to make sure we hit on this. It's not all rosy. Consumers are starting to overextend themselves. Not everybody. I think this is largely a story of a bifurcated economy. Some folks are doing very well. Some are falling behind, and you can see this in revolving credit balances. What happened in 2020? Why did revolving consumer credit fall off? Stimulus payments. Money got sent directly to consumer bank accounts, and a lot of people, to their credit, used that money responsibly. They paid down their debt. They got ahead of it. Delinquency rates fell to historic lows. So it wasn't just that we were throwing it into meme stocks or anything. A lot of people used that money well. and then it ticked back up. People are using their revolving credit more and more, and this data just came out late last week. Looks like delinquencies are trending back to a new high, or at least higher than we saw in the prior cycle. So there's a hint that there are more consumers who are using credit and not necessarily using it responsibly. That makes me nervous. That does mean some households are overstretched and could be heading towards some greater pain, like evictions, like auto repossessions, the sort of things that can be quite traumatic episodes to live through and can really feel like we are in recessionary territory. Even as the jobs market is good, that doesn't mean everyone is keeping pace. We can go to the next slide. So, as I say, this is mostly a good story, despite that ending note I just had. But there is a case for the Fed to cut in March. Futures traders weren't crazy to think maybe it's time. And the Fed press conference had this odd dynamic of reporters who are usually pretty critical, kind of make the Fed chair work hard, put him on the spot. So a lot of the reporters' questions were saying, look at all the good progress you've made by all of these standards you set out over the past year. It looks like we're ready for cuts, aren't we? Good job. Congratulations. Why not cut? And just a couple of examples they cited, inflation is coming down materially. The Fed targets 2% core inflation. You can see that flat line there. We got way above it no matter how you measure it. We were well above target. Remember, inflation, as I said, is a measure of the rate of change in prices. If you just look at how much prices have changed over the past 3 or past 6 months, that 2% target is achieved. We're doing very well at the moment. On a year-over-year basis, not quite. It's down to 2.9% from a peak of about 5.6. So that's real progress. 2.9 is not 2. It's good momentum. We're heading in the right place. We are not there yet. Powell was also quick to call out that a lot of the disinflation we're seeing is coming from goods. There was a huge bubble in goods. Everybody was staying home, renovating their houses, buying whatever toys the kids wanted, just try to make life more entertaining. We're still dealing with ripple effects of that surge in goods demand. So goods prices have been steady to falling while services are hot. Energy has also been in a down cycle. That's excluded from core, but that's also helping keep inflation low for the past few months. You can't guarantee that's going to happen. Ultimately, I view this as Federal Reserve governors being historians. There have been many cycles before where Fed leadership got ahead of themselves. They saw inflation starting to improve. They wanted to show some signs of optimism to the economy, and they cut too soon. Inflation took off again. Let's give it a few more months, make sure we are in a steady place. We're confident inflation won't come back. We have to be modest. After so many people got that inflation call wrong, we know that it can come back. What's also worth calling out are inflation expectations, shown here in the lower left. They stayed pretty anchored. Inflation can be self-fulfilling. If people expect higher prices, sellers will raise their prices, and consumers or business buyers will still buy them because, oh yeah, that was the inflationary hike we were expecting. That can become a cycle unto itself. And as inflation took off, generally in surveyed expectations, this is hard to quantify, but surveys indicated a year out, yeah, we do expect inflation is going to stay high. But for instance, this University of Michigan 5-year survey, no, 5 years out, we don't think inflation will stay all that bad. So overall, expectations stayed pretty anchored. And now 1 year out, they're aligned with the 5-year level. That's really good. That means the Fed has kind of won the psychological battle of helping keep inflations anchored, helping maintain the expectation that inflation won't take off again. That's very good. Let's just make sure. Let's see some more of this encouraging data and make sure that we are in a good state. While I'm being topical, we had a pretty busy January. And on the next slide, let's dig a bit into one of the headlines that I didn't welcome the return of worries about commercial real estate. This is real, but it's not new. However, one bank in particular, New York Community Bank, had to really take some lumps related to their commercial real estate portfolio. From what I can tell, a lot of this was unique to NYCB because they took on so much of the asset base of Signature Bank, which failed alongside Silicon Valley Bank last March. That brought NYCB into the $100 billion asset threshold where capital standards become a lot higher. They had to take some adjustments. They had to add to their capital just to make sure they met their ratios and did not get any supervisory findings. That cut into their dividend. That really padded out their loan loss reserves. So a lot of this is specific to New York Community Bank, but it did renew worries about the asset portfolios of all the big commercial banks. They're still sitting on a lot of commercial real estate. I'm on the slide that says commercial real estate worries persist. I think it's one ahead. How much do we have to worry about this? And to my mind, nothing really changed fundamentally in this market. CRE is tough. Banks lent heavily into this market. They hold these assets on their balance sheets. Some of the Class A properties do get repackaged as commercial mortgage-backed securities, but by and large, banks are sitting on big commercial real estate buckets. CRE is too broad of a category to be meaningful when a lot of CRE is doing fine. We couldn't build warehouses fast enough during the pandemic. Industrial is benefiting from certain federal stimulus measures. Multifamily in a lot of markets continues to find tenants. Whatever gets built gets occupied. So CRE broadly is okay. It's city center office CRE that is a problem. Now, those of you who have come downtown have seen it's not dead. All right, I'm back in the office, despite what you see today. I'm back in the office at least 3 days a week by mandate, but I don't mind at all. We are using less office space, but it's not zero office space. You don't hear of companies going fully remote anymore. That was a pandemic phenomenon. It seems to be gone, and there are downsides to being fully remote. So there are some calls to return to the office, and I think they're being met, but there's a level shift downward in terms of office demand. There will be negotiations happening. They will be tense. We'll never really know the outcomes. It's hard to value properties when there's so much uncertain demand, a lot of concessions being made. So banks are realizing some losses. Some borrowers may have to bring some cash to their loans as the loans are renegotiated. And this is going to stretch out for years. CRE loans are typically 5 to 10 years long, so many of them predate the pandemic. And banks are going to have to work with their borrowers. No bank wants to repossess an office building. It's going to be prolonged pain. It always was. And we always worried, would there be another shoe to drop coming out of the Silicon Valley Bank crisis, which the industry showed a lot of resilience coming out of that. It was good. Was it almost too good to be true? Well, NYCB was close to failing. It looks like they're going to make it through this quarter. But we can't really be sure what the next bank will be. What do we have to worry about? Will this be too much for any bank to endure? Now, I think you're one slide ahead. I'm still on the commercial real estate slide. Just wanted to note, when banks are worried about a sector, they stop lending into it. They want to tighten down, make sure they're safe and sound with the portfolio that they have before they try to grow. Predictably, lending standards for commercial real estate got really strict last year in the wake of Silicon Valley Bank, but they were already tightening up. You see this in the lower left. Banks were less willing to lend into CRE in the first place. An interesting leg down in the first quarter data. All right, this is the survey of senior loan officer opinions. Are you willing to lend into these various asset classes? That's still net tightening, but quite an inflection point. This means banks are starting to explore the waters again. The worst of the stress is probably over. They have to worry about their assets for years to come. You can't just tighten down forever. That will eventually strangle the economy. So interesting to see across all sorts of commercial loan types, banks got a little less stringent in the first quarter. That bodes well. If that stayed too tight for too long, that's one contagion vector where stress could spread throughout the economy. We'll go to the next slide. That was commercial real estate. Let's talk a bit about housing, which has been surprisingly resilient, which I know I'm overusing the word resilient, but housing has really held up. I was expecting a modest correction or at least a flatlining in terms of home values, but there's simply too little supply out there. Even though prices are high, even though interest rates are high, there are still qualified buyers who are out shopping, having these important life events like relocation, like having children. That's all fundamentally good. A lot has to go right in your life for you to qualify for a mortgage. It is still a stringent underwriting process. When we go shopping, we're not finding houses, so they're getting snapped up, and that is supporting house prices. I'm really surprised by this because we saw a 40% gain in the pandemic. Anyone who was thinking of buying a home or upgrading in the years ahead went shopping, and that drove up prices. This is a market that couldn't respond to that demand shock. It takes a while to build a house under the best circumstances. 6 months to snap together a single family home, assuming you have the land and the permits and everything in place. These were not the best circumstances, so prices reacted accordingly. No change in supply, huge increase in demand. This is what you'd expect. Still very little change in supply and still enough demand to keep prices moving upward. This is great news if you're a homeowner. This is difficult news if you're a home shopper. This is really bad news if you're a first-time home buyer and trying to get into markets. It's quite tough. Just to put it in context, you can see in the lower left, our inventories are really, really low, like holding consistent with early to mid 1990s levels of vacant homes for sale or for rent. Since the mid 1990s, the US population has grown about 24%. So we've got a quarter more people looking for the same amount of housing. That is a tremendous disconnect. I think there's a huge opportunity to build here. Whatever gets built will get occupied eventually. I understand that investors got burned in the prior cycle. That was a housing-led recession that led to the financial crisis. So I see why we were hesitant to build, but I think we can now say with some confidence that we underbuilt. Let's keep stepping through the economy. On the next slide, corporate finances have momentum. This is for, the bigger firms are doing pretty well. They've insulated themselves from the effects of higher interest rates. It was clear back in 2021, rate hikes were coming. We didn't quite know how quickly or just how big those increments would be, but we knew debt was going to get more expensive. So there was a lot of bond issuance out into capital markets, all found buyers. A lot of debt is locked in at a nice low interest rate. A lot of cash still sits on balance sheets. So as we wonder, how did the Fed increase rates by over 5 percentage points in just over a year and it didn't careen us into a recession? Well, we insulated ourselves. Corporate balance sheets full of cash. What did homeowners do? Refinance their mortgages, termed it out for 30 years. What a benefit to living in the US that we can do that. So that's how most people are feeling higher interest rates would be through the housing market, and we just don't have that pass-through effect. If anything, we're feeling it when it's time to shop for a car, time to buy the next house, but most debt is not revolving, not variable rate. If you're carrying a credit card balance, then you're feeling it, but those were never cheap to begin with. So this is one reason, corporations have held up very well and haven't really felt the burden of high interest rates. But on the next slide, let's talk about the smaller businesses, the ones that can't go out in capital markets and issue bonds. Small businesses are much more reliant on bank lending, usually revolving lines, usually variable rate. So they're the ones who were feeling the effects of high interest rates. Thus far, they've held up. And what's been really shocking, I haven't heard one single cogent narrative around this. It's a lot of anecdotes, and it's all generally a positive story. In the pandemic, applications for new businesses shot up, and they were high propensity. We've now seen actual formations have followed the applications. A lot of people struck out on their own, and a lot of them are employing. I think that's part of the reason we're feeling we are shy of workers. A lot of people have struck out on their own. So there are more small businesses out there, but they're launching right into a tight credit cycle. This could be problematic. We don't have a lot of evidence of closures just yet. Yelp, the consumer review site, has some really interesting economic analyses that they put out, and they showed 2023 was their own record year for new businesses appearing on their platform. Some closures mixed in there as well, but it hasn't been a bad run for closures quite yet. So this is something to keep an eye on. I think if you're following stock markets, where you see this story play out, it's the divergence between the Dow or the S&P, the big blue chip companies, versus the Russell 2000 or the 5000. Those are the smaller businesses. They did not perform like the S&P did. Apologies if you hear my crazy dog in the background. They were exposed to the high interest rates, and they're feeling it. So we saw it in those results as well. Keep an eye on small businesses. They're the job creators. They're so important for wealth creation. Even just pay attention when you hear a local business closing. Are they on social media, and do they explain why? Was it time for retirement, or was it that the bank called their loan? Keep an eye for the economic stories or not. Small businesses are worried. I track this National Federation of Independent Business survey. More business owners are citing that they expect tighter credit when that was never really a worry in the prior cycle. So it is something to keep an eye on. So on the next slide, this is a whole lot to walk through in terms of what is on the minds of the Fed governors. The slide, releasing the brakes, you got it. Eventually, they're going to cut. This is a good discussion to have. The Fed will cut at some point this year. Will it be March? Probably not, unless something breaks in the month ahead, but I have no reason to expect that. It's coming soon. We are seeing futures markets are volatile, they're repricing heavily. They've priced away from March. I don't find futures markets all that instructive, except for the next meeting. And I think we're at a 80% likelihood of holding at the next meeting. I would agree with that. Beyond that, it's anyone's guess. It's probably coming. Our latest forecast says June, and then 3 cuts thereafter. We'll see. As I say, there's no playbook for the soft landing. We're all taking this 1 month at a time. What's also going to be important on the lower left, the Fed balance sheet strategy. You can see the Fed bought a lot of treasuries. We did a lot of stimulus in the wake of the pandemic. I don't mean that critically. It was important. The Fed was buying a lot of that debt because they can issue money freely, and they did so. They've been running down that portfolio. $1.4 trillion from the peak. Money has just plain vanished. The way it works is if the Fed is holding a security that matures, the Treasury gives the money to the Fed just writes off that ledger entry. The money never really existed in a paper form. Now that money ceases to exist. So they're winding down their securities portfolio. It's a sign that they took on a lot, maybe more than the market needed. If they can wind down by 1.4 trillion and no one notices, Powell has promised this will be agenda item number 1 at the March meeting. When will that rundown stop? There will come a point that this will cause some pressure, maybe in Treasury market auctions, maybe more likely in bank overnight funding. We don't quite know. So thus far, it's been a steady pay down. It's likely to curtail at some point this year, and that'll be another form of, if not easing, at least less tightening. On the next slide, as I say, we ran up a lot of debt. The U.S. is not alone in this. There was a lot of stimulus went out. We're not done spending. We passed a lot of longer running stimulus measures, which we can debate if they're the right or wrong idea. That's a separate topic. Point is, we're all borrowing, and the borrowing costs more. We run a structural deficit. As we roll over debt, we have to issue new debt, and the new security that is issued is going to be at a higher interest rate than whatever was just retired. That means the debt is more expensive and it's going to crowd out other spending. This will be a challenge all around the world. The U.S. is, in a sense, catching up with many European nations, but it is going to be more and more of a burden, not talking about the election cycle, not talking about next year. I mean, really for the rest of my life. But it is, of course, a salient political issue. And on the next slide, we are still staring down a potential government shutdown. The can has been kicked a few times in this cycle. With the first one, Kevin McCarthy lost his speakership. Little turmoil there, replaced with Mike Johnson, who's also passed a couple continuing resolutions. So we don't have a budget for fiscal 2024 yet. That's not necessarily a problem. There have been entire years, not long ago, that continuing resolutions were used for over a year. It's fine. It keeps the government open. If we want to have an actual discussion about lowering the deficit, getting toward a balanced budget, I'm not hearing it yet. We're quibbling over kind of 1% here and there. What are we doing in terms of the border, Ukraine, or what have you? I don't want to make light of any of those discussions. They're just really small spending amounts relative to our $4 trillion tax base and $6 trillion of government spending. They're quite small. So I believe in the background they're working toward a budget bill. There was an announcement of a headline figure a few weeks ago with no details supporting it. But it is a hard discussion, and it's not going to go away. And I don't want to belabor it too much, especially in an election year. We're going to hear a lot about government spending. I don't think we'll hear good proposals. If you want to explore it, I strongly recommend CFRB, Committee for a Responsible Federal Budget. They've got responsible right in the name, so you know when it comes to policy discussions which side they err on, but they've got this tool called the Debt Fixer at CFRB.org. You can go line by line in the federal budget. If you want to get to a balanced budget, what are you going to cut or which taxes are you going to increase? It's all difficult and all very politically unpopular. To start getting into entitlement cuts or military cuts or tax hikes, those are all political suicide. So it's been cheap. It's been easy to kick the can, and we're going to keep seeing that can getting kicked, but it won't be so cheap anymore. And eventually voters will hold their elected officials to account, but I don't see it happening yet. Get through a few other key themes here. I want to make sure we mention China. I'm 2 slides forward, setting in the East. As I said at the outset, it's a whole new China. China got to where they are by exports. They took over so much productive capacity from the rest of the world. They grew. They took on a lot of debt to keep growing, to build the infrastructure they needed for those factories. And that's simply over. Even if we had world peace, even if we totally trusted China, we learned in the pandemic it is a risk to concentrate so much production in one part of the world. We've taken action on that with the CHIPS Act to say, oh, it was decades of rational business decisions that put so much semiconductor production in China and Taiwan. What if there's a natural disaster? What if there's a shipping disruption? What if there's another pandemic? We should have more than one part of the world making these chips. So we're subsidizing production in the US. Construction is underway. We're not online yet, but ground is broken on chip fabricators. It's real. That's the example of reshoring. China also has to worry about all the debt that they've taken on. I don't worry about this as a global contagion vector because so much Chinese debt is held domestically. They are a culture of saving. So if there's stress, like Evergrande was just back in the news, looks like they'll be heading to bankruptcy at last. Not a whole lot of international holders of that debt who are going to feel the stress. And China never really looked to international investment to buy their debt. They were looking for foreign direct investment. They won't get nearly as much. So as I say on the next slide, reshoring is real. There's a massive debt burden to be sorted out. And of course, a lot of geopolitical tensions. A lot of reasons to question China's motives, what could happen with Taiwan or tensions throughout the South China Sea. It's the wrong time to keep investing into China. All China can do at this point is try to fight to maintain their share, but it's going to be an uphill battle for them. A big opportunity for a lot of other nations, though. Let's jump a few slides out in the interest of time, just to hit on some long-running trends. Diminished demographics. This is a bigger worry. Again, not a next year, but as I think about upcoming generations, it's not just a U.S. worry, but it's really every advanced economy is going to struggle with more older people living longer, mostly healthier lives. But we have social safety nets for them. This is the root of why we can't balance our budget and why it's impossible looking forward. So much spending on Social Security and on Medicare. I don't complain about those programs, but they come at a cost. This is a burden that'll be shared all over the world. Birth rates are lower. Immigration flows aren't what they used to be. And of course, that is a contentious topic. We have to get as much as we can out of every worker that we have. And we have to train the next generation as best as we can because this is going to be a long-running burden. We're talking through the year 2050 is about where we have to get before the U.S. demographic projections look a little better. One vector for maybe a productivity enhancement on the next slide, artificial intelligence. What I'm about to say is it's coming. And you'll say, Ryan, what are you talking about? I've been playing with ChatGPT for more than a year. It's given me recipes, it planned my vacation or whatever. That was important a little over a year ago when the big generative AI splash happened. ChatGPT went live, Google and Microsoft and others followed very quickly. This was new. This was a real light bulb moment. Wow, something new is happening. I can talk to the internet and it talks back to me in plain language, or it draws me a picture. Sometimes it's even correct. Like this has huge potential. This is going to change the world. I feel like that was the moment of peak hype. Just being able to generate text is not going to change the world on its own, but it does show AI is real and the investments are underway. Again, behind closed doors, people are looking for competitive advantage here, but the projects are happening, and I think the real wins might be kind of kept proprietary. I haven't heard any great outcomes yet, but it's real. The best example I've heard, I hope I didn't share this last year. I got to hear Satya Nadella speak, CEO of Microsoft. And admit your biases, the CEO of Microsoft is going to be very bullish on AI. This is a huge growth vector for them. But he gave the example of the hardest job to fill in technology is information security. For any large network, like for instance, Northern Trust, there is a locked room somewhere in headquarters full of computer screens. There are technicians there monitoring the firewalls, the email traffic, web traffic, looking for any kind of virus, cyber attacks. It has to be inside. You can't do this over a VPN. Staffed around the clock, 365 days a year. That's hard, to be in a windowless room, staring at screens through the night. And let's be honest, it doesn't require a master's degree to read a firewall log. It takes a little specialized training. This can be an example. You get people through, 3-course community college certificate program, pair them with the right AI tools to recognize the patterns, and where there are differences in the patterns, that could be enough to fill an important gap in the labor force. So that's the sort of story that makes me optimistic, that we can make workers more productive. Maybe this is real. I hope to see some gains from it, but it's going to still take some time. The next slide, I don't want to, I'm not talking about the election, and I don't want to dwell on this too much, but we are in a more polarized world. It's not just in the US, of course, it's happening internationally and it's happening domestically all around the world, right at a time that so many countries are going to the polls. And we're seeing some surprising outcomes across a few, like even Pakistan now in the news for a surprising sort of revolt from the public and who they elected. This is going to make cooperation difficult just at a time that we need a lot of cooperation. We need to make some investments. We need to make some difficult decisions along the way. And it's going to take cooperation that's hard to come by. If I have any glimmer of optimism, it's that we can respond to a crisis. We saw it with COVID. Novel virus, massive pandemic. There's a lot we didn't understand, but we understood it was a respiratory virus. We need to keep our distance. Let's shut everything down temporarily as best we can, pass some stimulus to get people through a temporary crisis and not have permanent damage. It was a win. Look, we can argue a few of those programs were too generous, but we got through it. We don't have a lot of scarring from COVID in terms of economic damage. And in the US, we're growing at a faster rate than we were before. I bring that up to say, when there's a crisis, when there is a common enemy, we can still come together because all those bills were passed right after Trump's first impeachment. All right. We had never been more polarized, and then we came together. So it is still possible if we can unite on a common enemy. We do know how to fight it. Speaking of fighting, unfortunately, I'm not proud of that transition. We do have to worry about Israel-Gaza. This is thoughts on the Middle East in a couple slides. It's not much of an economic story. It's a humanitarian crisis, first and foremost. Where we have to worry economically is this going to hit energy markets just because it's the Middle East? Israel is not a big oil producer, but as soon as that attack happened, fingers got pointed at Iran. And Iran was not part of it. They swore it off. Looks like those were just rumors. But Iran is no ally of Israel. They're okay with a little tension. They don't really want a war on their doorstep. So a lot of eyes on Iran and how the alliances can work out. Attacks are, rampant throughout the Red Sea region. This is not good. This could be inflationary in the near term. Goods have given up a lot of inflation. Now everything's getting rerouted, around the Cape of Good Hope rather than through the Middle East. This is not a good state to be in. So we've been fortunate in terms of low oil prices. And actually what's held it down, contrary to conventional wisdom, has been U.S. production. We're helping to keep oil markets afloat. And we haven't seen a big price response in energy. But of course, if things really get worse in the Middle East, that's probably the first vector where we would feel it. Investments are happening in green energy to be less petroleum dependent. We can't replace it overnight. It's happening worldwide. Europe is more motivated than we are after they lost natural gas supplies from Russia. They've had to rally, and that includes importing a lot of natural gas. They can't just go to all solar and wind overnight, and it doesn't work for everything. Those investments are real. They're happening, and we are heading toward a more mixed and thus hopefully more resilient energy infrastructure, but it's going to take a very long time and a lot of investment. We can go 2 slides out to our latest forecast, just so I can conclude here and hopefully have time for a couple questions. We are, as I say, sticking with the soft landing. We are out with a forecast of positive growth, maybe slowing down. It has to slow down a bit from where we've been. We can't expect these 3, 4, 5 handles like we saw in the first half, but they'll come down. We have every reason to believe that if we've made it this far, we can keep it up. Unemployment may increase modestly. We will see some layoffs. I don't mean to make light of that, but inflation is going to keep coming down at a steady pace. That's going to re-anchor expectations. It'll make for a calmer year ahead, I hope. This puts the Fed in a position to start cutting mid-year. As I say, we're at June. Hard to say exactly. Could be a meeting sooner, could be a couple later if they want to be cautious. That would be understandable. That would be a communications challenge. And that will gradually bring interest rates down along with the rest of it. Relative to the rest of the world, the U.S. is looking really strong. Other markets have not thrived as we did, really were affected, especially by Russia, Ukraine, in a way that we weren't. It did affect the whole world. It was much worse in Europe in terms of their food and energy supplies. And they're still dealing with that burden. And we've got a slower China to reckon with as well. But if we've made it this far, I do believe we can keep growing and we'll be up for whatever other challenges arise in the year ahead. Have any questions come in along the way?
Let me check. Yes.
Oh, now I can see a Q&A.
There we go. Okay. Could you offer any perspective on the role of housing on the overall economy, particularly consumer perceptions of inflation?
Yeah, happy to. And now I see you right after that, you said the chart answered your questions. But no, in terms of inflation expectations, it is important. There's been an odd divergence here. The category that has led headline inflation up and even core inflation has been housing. There's been a massive lag between the rents that are actually observed in the markets, which have been basically flat. Again, it's generalizing the whole nation. Certainly, some people have seen their rents increase, but mostly flat, not a lot of hikes over the past year. And yet, CPI and PCE measures of housing inflation have stayed quite high. So they're lagged by a year or more. If you're out in the market looking to get an apartment, especially if you're a first-time home buyer, this makes you think inflation is out of control. This is where prices have increased a lot. Or if you just haven't shopped for 10 years or so. I mean, I'd share the personal example here. We bought this house in 2012. I'm very proud to say that. I got that timing right. I didn't expect we'd stay here forever. Thought maybe we'd upgrade one day. And as I looked around the neighborhood, I don't want to leave our school district now that the kids have grown some roots. It's simply not affordable. I'm doing okay at Northern Trust, not that well. So instead, we're plotting an addition. Those of us who bought homes pre-pandemic, and remember, most people didn't move, we're kind of stuck. That is decreasing housing supply further. Not much new construction is coming online, but a lot of us can't afford to move. We're sticking with our houses. That's further depressing supply. More older people, as they tend to be healthier into their 60s and 70s, are choosing to age in place when they might have previously chosen to downsize or become multi-generational households. So there's all these factors that are holding supply tight and making it seem that inflation is really, or excuse me, housing costs are really high, leading to the perception that inflation overall is quite high. But there are so many measures of inflation. If you take housing out of it, it's pretty well under control. There's an interesting measure called Truflation, which is just a web scraper. But basically, it's looking at prices all over the internet, like including grocery stores, like every price that it can find in real time, it's continually updating. That thing's been under 2% for a while. So in terms of the prices we're actually paying day by day, it hasn't been bad, but then we can always find something to point at, whether that was it one holiday season ago, eggs. Oh my goodness, $8 for a carton of eggs. That's crazy. Eggs didn't make anyone broke, but it was just an example. There's always something. And lately it's housing. Maybe that's something that makes people think, wow, prices are out of control. Oh, and there was a question, will we get slides? And those are, I'll leave it to DuPage Foundation, but yes, these are free to distribute.
I think that was it on the questions for today. So Marty, I don't know if you wanted to review.
Yeah, maybe Ryan, thanks very much. We appreciate your time.
Thanks so much for having me.
Maybe it looks like I can't screen share actually, Matt. It's saying it's disabled.
Let me. Second. Okay, you should be able to now. Sorry about that.
Yeah, no worries. All right, hopefully it looks like I'll be coming in. Hopefully you can see my screen, Matt.
Mm-hmm.
Okay. Yeah, so I'm not going to cover too much of the executive summary. Ryan did a really good job of giving the setup and the economy. But maybe just looking at kind of the portfolio and the returns. These are going to be the returns in the fourth quarter. Also give kind of a recap what happened in 2023. So for the fourth quarter, as you can see, all the bars are up. It's always good to see. We're talking about investments. So we did see contributions finally from the left-hand side of the page, risk control, which is primarily investment grade fixed income. And then the right-hand side, we have the risk-seeking assets in the portfolio, led by equities, primarily in the US, and by real estate, which finally saw a rebound in performance in the fourth quarter. We talked in the previous meeting about the narrowness of the US equity market, kind of being led by Magnificent Seven, high growth, high capitalization tech names driving the market. In the fourth quarter, we started to see that broaden out. Small cap stocks performed well, value stocks performed well. So at least through the fourth quarter, that was constructive. Unfortunately, kind of through January, the early part of February, we've seen this reversal back to the 2023 playbook where small cap is continuing to underperform large, value stocks are continuing to underperform growth. And so what we're really hoping to see, at least in the market, is a broadening out of those exposures. It's more healthy for the market to not be led by 7 to 10 names. I won't cover the page. Just real quickly on valuations. Valuations are extended. We don't consider valuation kind of determining factor in short-term market returns. Has a much bigger impact over longer periods of time. Just starting points are important. Valuations are elevated today, and that makes us a little bit more cautious on equities, at least in the U.S., than kind of maybe the market performance maybe would tell you. So we kind of go to the next page on page 40. This is where we're giving our outlook for equities. So very low expected returns. Again, these are kind of carrying in our expectations for earnings and multiple compression from the PEs and dividend returns, giving very low single-digit expected returns over the next 12 months. This really has a lot to do with the market pricing in pretty good earnings growth for calendar year 2024, about 11% in that chart up in the top right, and our own Northern Trust expectations that we'll have a little bit more modest growth, more in the 8% range. So if earnings do come in weaker than expected, we will probably see some multiple compression in the market. If that doesn't happen, that'd be great for risk assets in our equity markets. We could potentially see better returns. Brian did a good job covering interest rates, kind of rolling it forward to how we feel about credit markets. So our expectation for the 10-year yield is in the green box on the left, kind of 3.75 to 4.25 range. Importantly, we've traded at both ends of that range recently. We're at the higher end of that range today. It wasn't that long ago we were at or below the bottom end of that range. So settling into this trading range and the 10-year yield is a good development for fixed income markets. We saw that with the good returns in the fourth quarter. And if we do see a stabilization in those rates, the high current yields will provide some good returns in 2024. On the real asset side, I talked about real estate actually outperforming global equities for the first time in a while in the fourth quarter. You can see in the top right-hand side of the chart here that real estate kind of starting around the Fed pivot talks in November started to outperform global equities. Real estate is an asset class much more sensitive to interest rates and changes in interest rates, potential changes in interest rates. So with the Fed pivot to a tightening posture versus their looser posture previously, real estate, at least on the equity side, it underperformed. But when we got that Fed pivot to a more accommodating environment, we started to see real estate equities start to outperform. So from a portfolio positioning perspective, kind of get everyone up to date on kind of our current positioning. We've really come back to center on portfolio positioning, kind of back to neutral versus our long-term strategic targets in DuPage Foundation's portfolio. Really the kind of outliers are still, we see outsized opportunities in high yield versus inflation-linked or TIPS fixed income. And we've brought emerging markets back to a neutral weight. And we're basically carrying our underweight to equities in the developed market space, which is primarily Europe and Japan. Every other asset class we've brought back to neutral. So from a base case and risk case perspective, Ryan kind of previewed this, soft landing in the economy, the Fed transitioning to a cutting rates environment. So we're always thinking about what are the risk cases, what can go wrong in this kind of Goldilocks environment or soft landing environment that we're in today. The Fed has still raised rates 5% plus over the past couple of years, and we could continue to see the lagged impacts of that. So that's a risk case for us, that the soft landing turns into a hard landing. And then again, Ryan previewed kind of that red situation going on in the Middle East and the Red Sea, putting pressure on shipping rates in the Middle East. It's primarily a Europe problem. We have seen a slight pickup in shipping costs in the United States, but that's also something where we think that if the Middle East conflict would widen out or there's a bigger impact on shipping, that would be a risk case for inflation, which would again kind of fold its way forward into the Fed, potentially not cutting rates as expected. So current snapshot of the portfolio on page 46. Here we're kind of looking at the current allocations versus those long-term strategic targets in the investment policy statement. So as I previewed, we're neutral or equal weighted to U.S. equities, underweight developed market equities, and we've been increasing our exposure to emerging markets. It's a place where we were underweight for most of 2023, with holding overweight to natural resources to offset that. Our shifting has changed slightly on emerging markets. We're much more constructive. We think they'll see positive, much above trend growth in earnings in emerging market space. So that's a place that we've been adding to in our client portfolios. Fixed income, as I previewed, we're kind of neutral to investment grade fixed income, still slightly overweight high yield, where we think they're outsized returns versus investment grade. And then the alternative side, kind of neutral or equal weighted versus the investment policy statement targets. Importantly, we've been building the private equity portion of the portfolio. We're up to 15% of the assets, kind of at target. We're kind of in transition in the private equity side. We have a few older legacy private equity holdings that we'll be getting distributions from. We've added in a few newer private equity investments to try to infuse that portfolio. And so we're very happy with the way that alternatives portion of the portfolio has been ramping up. Jump into the performance. So this is the performance through year end or through December. And I know these numbers get kind of small on the screen, so I will zoom it in slightly. So for the fourth quarter, equity returns in the portfolio up 11%, in line with the custom benchmark that we have set up for DuPage Foundation. On the fixed income side, slightly above benchmark with almost 7% returns on the fixed income side, and then alternatives, kind of low single digits. Commodities as an asset class didn't have the best quarter, but as I mentioned, real estate had a really good fourth quarter. So year to date, for calendar year 2023, equities in the portfolio up almost 19%. A great year for equities. Slightly behind the custom benchmark. We did a good job repositioning the equity side of the portfolio mid-year to try to position for this more resilient economic environment versus kind of where we were a little more conservatively positioned early in the year. And so we're able to kind of capture the bulk of those upside returns on the equity side in the fourth quarter. Fixed income for the year up almost 8%, kind of driven by the high yield market, which was up almost 13%. And then the private equity portion of the portfolio, remember this is reported on a lag basis. This will be the private equity marks through the third quarter of 2023, up 11% for the year. We'll be getting those fourth quarter marks as we roll into the second quarter of this year. And it looks like we're kind of bumping up on time, Matt. So I guess I'll stop there and see if there's any questions before we kind of run out of time.
Sorry about that. Didn't realize I was on mute. Doesn't look like we have anything in the queue. So with that, I'd like to thank everyone for joining us today. Thank you to Marty. Thank you to Ryan. And thanks to everyone.
Bye, everyone.